Hello everyone. The following video was put together a few years ago now. The graphics are a bit vintage, but the content is relatively timeless. I hope you'll find value in it, and thanks for watching. In this chapter, we take a closer look at an accounting tool known as a break-even analysis, the formula, the picture, and the pieces that make up this analysis, such as fixed costs, variable costs, sales line, break-even point, profit region, and the loss region. We discuss items that make it a little more complicated. We compare the items between an income statement and the break-even analysis, all with the goal to visually understand our profit enhancement concept in the next chapter. Now let's get started. This analysis is also known by several other names: break-even point, break-even formula, break-even model, cost volume profit analysis, expense volume profit analysis. The most common name is the break-even analysis, which is a tool in the form of a formula for the business owner to provide an estimation of the level of activity that needs to be accomplished to break even or begin showing a profit. This formula can be represented by a visual graph with the vertical axis representing dollars and the horizontal axis representing the level of the activity in the form of units, hours, or sales, all within a time frame or over the course of time. This model or analysis is based on several variables. The first to look at is fixed costs. According to Wikipedia, fixed costs are business expenses that are not dependent on the level of goods or services produced by the business. They tend to be time-related. Fixed costs are defined as expenses that do not change as a function of the activity of a business within the relevant period. An example, a retailer must pay rent and utility bills irrespective of sales. Other examples of fixed costs are insurance, telephone, and administrative salaries. The fixed costs are represented on the graph as a straight horizontal line. The straight line signifies that the costs are the same or are fixed without regard to the various levels of activity in that particular time frame. Now let's look at variable costs. Variable costs are expenses that change in proportion to the activity of a business. Variable costs are sometimes called unit level costs as they vary with the number of units produced. Some examples would be direct labor, direct materials, sales commission, packaging. Another example would be paper costs for a printing company. The more jobs printed means more paper used. Now, let's look at sales. The sales represent the selling price times the number of units sold. The units can be in hours or products. To help understand this analysis, let's take a look at a situation where we have a small professional service business with one employee. The employee charges or bills out for services at $100 an hour. The employee is then paid $50 an hour. This business has monthly fixed expenses of rent, $3,800, utilities of $200, insurance of $700, and telephone costs of $300, for a total of $5,000 in fixed monthly expenses. With the graph's horizontal axis representing units and hours, the gray shaded area represents the fixed costs, of which do not change whether 1 hour is worked or 200 hours are worked. The sales line in this example represents hours times the billing amount, in this case $100 an hour. The slope of the line is based on these two variables and always starts at 0. So at 100 hours, the revenue would be at $10,000. The variable cost line always starts at the top of the fixed cost line and increases at its rate for every unit sold. In this case, the unit cost is $50, which is paid to the employee per hour. So for every unit or hours worked, the variable cost increases by $50. These two figures calculate the slope of this line. A test is at 100 hours times $50 an hour, the variable cost increased by $5,000. Now when you add the sales line to the graph, the point it intersects with the variable cost line represents the break-even point, which is where the fixed costs plus the variable costs equal the total costs, of which equal the total revenue. hence the break-even point of 100 hours at $100 per hour for $10,000 in revenue. The red shaded region is the loss region and is due to the total cost line being greater than the sales or revenue line within this level of activity. The break-even point is the shifting point between loss and profit, which means any activity greater than 100 hours produces profit. It's important to understand the lines and the information that this graph represents. In the next chapter, we do some what-ifs to shift these lines around to show the effect on profit based on possibilities. But before we get to that, there are some items that complicate the break-even analysis. Some costs don't fit easily in either the fixed or the variable costs category. These costs are referred to as semi-variable or mixed costs, and according to Wikipedia, this semi-variable cost is an expense which contains both a fixed cost component and a variable cost component. Examples are telephone bills or the cost of electricity, where there is generally a connection fee whether the service is used or not, which would be the fixed portion. As the usage or level of activity increases, the cost would increase accordingly. Another example is salaried employees who receive pay plus commissions based on the volume of sales. There is a formula to show the relationship between the mixed cost and the level of activity. In essence, the fixed portion is the cost at a zero level of activity for its availability, and the variable costs are the incremental increase based on the particular unit. Another issue to be aware of focuses on fixed costs. According to Wikipedia, fixed costs are not permanently fixed. They will change over time. By definition, there are no fixed costs in the long run, but are fixed in relation to the quantity of production for the relevant period. Another issue focuses on terminology. It's important to understand that those in economics may view the various expenses differently than those in the accounting field, and small business owners may have a different perspective altogether. But if we go back to Wikipedia, in accounting terminology, fixed costs will broadly include almost all costs which are not included in cost of goods sold, and variable costs are those captured in cost of goods sold. If we look at a small business income statement where we have sales, less the cost of goods sold, less the other expenses, we find it's the same basic information when compared to the break-even analysis, but from a different perspective, remembering and being aware that some expenses may be mixed or semi-variable costs. Understanding this helps when initially setting up the chart of accounts and the financial statements for a new business. In summary, the break-even analysis is relatively straightforward, but can get complicated. Analyzing each cost for the true break-even point could take some time. So applying the cost-benefit rule, examining the time spent versus the benefit to the company, should also be a consideration. We believe understanding the overall picture and information is the most important point, which helps in visually understanding our profit enhancement discussion in the next chapter.